When you see a stock that has skyrocketed nearly 700% in a single year, you really have to stop and ask yourself what exactly you're looking at.
Oh, absolutely. It's a massive anomaly.
Right. I mean, is this an incredibly undervalued, strong buy riding the absolute crest of the AI wave? Or are we staring at, a looming falling trend, flashing sell signals, and basically a highly engineered trap?
It really is the ultimate dividing line in the market right now.
Exactly. But hey, before we get into this deep dive, make sure to like the video, subscribe to our YouTube channel, and it is compulsory that you leave a comment with your feedback. Let us know if you are buying the hype or fading it.
Yeah, we definitely want to hear your take on this one.
So nothing captures this polarization quite like today's focus. We are looking at Applied Digital Corporation, ticker symbol APLD.
A fascinating case study right now.
Truly. And just for context, the date is April 20th, 2026. On the last trading day, this stock closed at $31.53.
Which was up, what, nearly 5%?
Yeah, up 4.79% just on that last day. But the daily action doesn't even tell the real story. When you zoom out to the 52-week range, the context is just staggering.
The spread is massive.
It's unreal. We are looking at a 52-week low of $3.81 and a high of $42.27.
Right, a spread of that magnitude in a 12-month window.
Yeah.
I mean, that implies a complete fundamental reshaping of how the market values the company.
You don't get a 700% swing on a slight earnings beat.
Exactly. You get it when the market believes the company is just an entirely different beast than it was a year ago.
It's like jumping on a financial roller coaster while totally blindfolded. You feel these massive vertical climbs and stomach-churning drops, but you have no idea what tracks are actually laid out in front of you.
That's a great way to put it.
So how exactly does a company go from trading under $4 to over 40 in a single year without fundamentally altering its entire DNA?
Well, the short answer is they absolutely did alter their DNA.
They had to, right?
Yeah. To understand a roughly 698% gain, you have to look past the ticker symbol. You have to look at the history of what Applied Digital actually does, and crucially, who is buying it now.
Because up until recently, anyone who knew the name Applied Digital probably associated them with Bitcoin mining.
Right. They were deeply embedded in that crypto infrastructure space.
Yeah.
But they've made this drastic pivot. They moved away from the volatility of crypto mining to become a major player in high-performance computing, or HPC, and AI data centers.
A completely different ballgame.
Exactly. And the latest news catalyst, the thing really pushing this, is the energizing of a facility they call Polaris Forge 1.
Oh, wow. Okay.
Yeah. And this massive expansion, securing 250 megawatts of capacity.
Wait, 250 megawatts. Let's just contextualize that for a second. That isn't just plugging in a few extra servers.
Not at all. It's a localized power plant, essentially.
Right. It's an enormous power draw, specifically tailored for hyperscale data centers, because crypto mining essentially just requires a warehouse, some cheap electricity, and heavy-duty fans.
Right. Pretty basic setup.
But AI hyperscale facilities, they require liquid cooling, near-perfect uptime, massive fiber redundancy, and structural reinforcement for incredibly heavy server racks.
It is a completely different tier of engineering.
Yeah.
And that engineering is exactly what the institutions are buying into right now.
The smart money.
Exactly. When you look at the order flow in our sources, the liquidity is incredibly high. We're talking about 19.77 million in trading volume.
That's huge.
It is. And the fact that it was trading near the high of the day at $31.72 tells us this isn't just retail traders throwing darts.
Right. Institutions are actively scaling in.
Heavily. Because Applied Digital is successfully securing these major hyperscale data center leases.
You know, I look at this pivot like a commercial landlord who finally decides to kick out a highly unpredictable tenant. The crypto miners paid the rent, sure, but their ability to pay fluctuated wildly.
Depending on the price of Bitcoin, yeah.
Exactly. So the landlord evicts them, guts the building, and turns around to rent the whole thing to a tech billionaire on a 10-year lease.
The prestige goes up, the revenue stabilizes.
Right. But I have to push back here. Are these institutional buyers just blindly chasing the AI buzzword, or is there tangible long-term substance to these new hyperscale leases?
Well, renting to billionaires sounds great in theory, but building the custom infrastructure to house them costs an absolute fortune.
It's definitely not cheap.
No, it's not. So let's look under the hood at the financial realities, starting with the income statement.
Okay, lay it on me.
You have explosive, triple-digit revenue growth. In their recent Q3, yes, but if you look at their EBITDA, which shows their core operational cash generation before interest and taxes. It's actually sitting at a positive $57.62 million.
Okay, so the day-to-day operations are generating cash. The engine works.
The engine works beautifully. It's the cost of building a massive new factory around that engine that's the issue.
And that reality is plastered all over the balance sheet and cash flow statements, right?
Exactly. Total assets are sitting at a massive $1.87 billion.
Almost $2 billion, due to the data center construction, I assume?
Correct. But to build that asset base, they've had to take on some incredibly heavy burdens. Total debt is up to $702.88 million to fund this expansion.
$700 million in debt. That is, wow.
And cash from operations is negative $115.4 million. Plus, their capital expenditure, the CapEx, is an aggressive negative $681.6 million for these AI-ready facilities.
Looking at this balance sheet is honestly like watching someone max out half a dozen credit cards just to build a mansion they hope they can rent out. Oh,
It is the definition of a capital-intensive race.
but I have to ask. With over $700 million in debt and negative cash flow from operations, how is a negative $231 million net income justifiable right now, even if they are in a massive growth phase?
Well, they justify it through the massive long-term contracts they are securing. But with heavy debt and massive growth colliding like this, the stock price action is guaranteed to be chaotic.
Which brings us straight to the technical analysis, and honestly, the immediate dangers for everyday investors.
The technicals right now are fascinating. From a trend direction perspective, it's an overall bullish trend.
So the long-term believers are holding the line.
Yeah. The price is sitting safely above the 50-day moving average, which is at $28.94. That flashes a standard buy signal.
And what about the 200-day?
It's well above the 200-day moving average of $26.81, indicating the long-term trend is firmly intact. A strong buy.
So the foundation is solid, but what about the momentum? Because that's where things usually get tricky.
Right, and they do. The 14-day RSI is sitting at 66.87.
Okay, so it's running hot.
Yeah, it shows strong momentum, but it is quickly approaching overbought territory, which makes it a neutral or cautious buy signal.
And our sources point out the MACD is at 0.66, which is kind of mixed, right?
Exactly. It shows a short-term bullish crossover, but some of the underlying oscillators are signaling short-term weakness, essentially flashing a sell for profit-taking.
So you literally have algorithms fighting each other at key levels. Let's map those out. Where is the support?
Immediate support is sitting right at $30.61. If that breaks, the next strong support level is way down at $24.97.
That's a huge drop, and on the upside.
Immediate resistance is right overhead at $32.09. If it breaks out past that, the target is $34.33.
So we have a really tight channel right now, but a huge floor if it falls, which brings us to the risks and the retail trap. The most alarming metric in the entire source packet is the beta.
Well, the beta is extreme. It's sitting at 7.27.
7.27. For context, if you hold an S&P 500 index fund, your beta is 1.0. A beta of 7.27 means this stock experiences massive, massive volatility compared to the broader market. It's like driving a hypercar on a sheet of black ice. One tiny overcorrection and you spin out completely.
And that extreme downside risk is exactly how retail traders get trapped.
Because they buy into the hype right at those resistance levels, right?
Yes. They see the AI news, they buy at $32, and then the extreme volatility swings downward to cool off that RSI. They panic sell at $25, and the institutions buy their shares at a discount.
So with the RSI creeping toward overbought and oscillators hinting at profit-taking, aren't retail investors walking straight into a trap if they buy the hype at today's resistance level?
It is a very dangerous setup for a short-term trade. The technicals show a stock balancing on a nice edge.
Right. So now we really must weigh the best-case recovery and growth scenario against the worst-case continuation lower. Let's get into the great debate.
Bull versus bear. Undervalued darling versus value trap.
Let's start with the bull case, the undervalued AI play.
The bull argument is that this transition to high-margin AI and HPC hosting is successfully driving triple-digit growth.
And APLD is absolutely crushing its sector peers, right? Our sources say they're beating RIOT and EQIX by over 150% in the last 6 months.
They are outperforming massively, which is why 11 different analysts give it a consensus strong buy rating.
11 analysts. That's a lot of consensus. What are their targets?
The average price target is $50.09. That is a 58.9% upside from where it is right now.
And the high target?
The high target is sitting at an incredible $99 a share.
$99. Wow.
Valuation-wise, its price-to-sales ratio actually makes it look undervalued compared to other pure-play AI peers.
But then we have the bear case, the value trap, and that starts with the negative earnings per share, right?
Yeah, the EPS is negative 38 cents. That makes it an incredibly high-risk asset right out of the gate.
And the customer concentration risk is terrifying. They rely way too heavily on a few major clients. It's like a high-end restaurant that only has 3 regular patrons.
That's a perfect analogy.
Right, because if even one of those patrons moves away, the entire business folds.
Exactly, and if a client backs out, they're still stuck with that $700 million plus debt load.
Which could act as a severe drag, especially if interest rates stay high.
Right, which makes the execution risk absolutely paramount. The worst-case scenario is that any delay in new facility energization, like Polaris Forge 1, will cause the stock to absolutely tank.
Flawless execution is mandatory at this valuation. So what is the actual outlook here, short-term versus long-term?
Short-term, expect consolidation near this 31 to 33 range.
Yeah.
The market needs to digest the massive run-up.
And long-term?
Long-term, there is a real potential push toward the 52-week high of $42.27. But again, it is entirely dependent on flawless execution.
I have to ask, though, with analysts throwing around a strong buy and a $99 high target, given the massive execution risk and that $700 million debt, isn't that $99 target incredibly overly optimistic?
It requires absolute perfection. It's the best-case scenario where everything goes exactly right for years.
Right, which rarely happens.
Exactly. So to summarize, APLD is a high-stakes, natural human debate between explosive AI growth and crushing debt mechanics.
The ultimate outcome remains highly uncertain.
Very much so.
And before we wrap up, we want to explicitly state that this deep dive is an exploration of the source data provided. Under no circumstances is this financial advice.
None at all. We are just looking at the numbers and the market psychology.
Exactly. But it does leave us with a massive cliffhanger to think about.
It really does.
If a company has to take on nearly $1 billion in debt and completely abandon its original business model just to compete in the AI infrastructure race, what does that tell us about the hidden costs of the broader AI revolution for the rest of the tech world?
That is the multi-trillion-dollar question right there.
It really is something to mull over until next time. Thanks for joining us on this deep dive.